Okay, let me take attendance real quick. Oops, wrong button. Okay. Emily Baker here. Matt Castles.
Here.
Do you guys hear me?
Yes.
Hello?
Hello.
Professor Kowalczyk, can you hear us?
All right, can you guys hear me?
Yes.
Try this.
Can you hear me now?
Yes.
Okay. Could you hear me before?
Yes.
Okay, I couldn't hear you guys.
You're coming through now with like
Yeah.
a little bit more bass.
Let me try and plug this headset back in.
All right, is this working now? Can you hear me?
Yes, we can. I think. I hope.
All right, well, I'm
hear
assuming,
us?
Owen, that you're saying you can hear me, but I can't hear you. So I'm going to turn this headset off. I wonder what I did wrong.
All right, so I'm assuming you can still hear me, but it might be a little bit more difficult. Maybe I'll bring it a little closer. All right, and Owen, can you say something so I can see if I can hear you?
Hi, Professor Kowalczyk.
All right, thank you. I can hear you. All right, so we're all set. That was kind of crazy. Let's do the attendance. I tried that and I couldn't hear if anybody was here. Okay, Emily, I see you're out there. Matt Castle.
Here.
All right, Peyton Ennis.
I'm here.
Saw you. Evan Gerber.
I'm here.
Hey, Travis.
Here.
Okay, Salem Huang.
Here.
Okay, Salam. I'm going to just click here because I know his microphone never works. Ruta Kuroda.
Here.
Okay, Connor Lubbock.
Here.
Destiny Merriweather. Destiny. Okay. Jeremy Meyer. Saw when you said him. Yep. Haley Phillips.
Here.
Okay. John Ratton.
Here.
Owen is here. And Lucas.
I'm here.
All right, good. Thank you. All right, so let's get back to what we were talking about last class. Oh, I'm going to grab a cup of coffee I just made. And we'll get started. Okay. When we left off, we were talking about Chapter 2 in the book. Chapter 2 is the review of accounting. And I know we had gotten through the income statement, and I think probably the last thing we talked about was the statement of retained earnings, right? So we had talked about how we had started the year with a certain amount. We added to that the income that we got from this year, subtracted out dividends that we paid, which gave us a net amount for our retained earnings. Once again, I don't know that there's too many of you that are out there that are accounting majors. So I'm going to apologize if it seems like some of the things that I talk about are just too elementary, but I just want to make sure that I cover certain things as far as concept-wise. Retained earnings is an interesting account that you keep on your books, in that what it really is it is a historical collection or accumulation of the earnings of the company that have not been distributed from the beginning of the company. Okay, so you start the company, and basically as an accounting entry at the end of every year, you have to think about it in terms of what your actual accounting records look like. You have certain accounts that are basically on your income statement. Those are going to be the revenue accounts, and they're going to be the expense accounts because you're going to compare your revenues and your expenses. Other accounts that you have on your chart of accounts are what we would refer to as long-term or balance sheet accounts. The income statement accounts, because of the fact that the income statement is a picture of a period of time, January 1st to December 31st, if it's a calendar year or fiscal year. In order to start the record over for the next accounting period, we have to zero out those income statement accounts. Okay, so one of the entries that you make as an accountant, the closing entries for an accounting period, is to close all of your revenue accounts against your expense accounts. And if you had income in that particular period, then what's going to happen is your revenue accounts, which are a credit balance, are going to be larger than your expense accounts, which are going to have debit balances. Okay, so that means you are not going, if you just want to zero those accounts out, you're not going to have a balanced entry. And in the double entry accounting world, we need all of our journal entries to balance to zero, that the debits equal the credits. So if we want to close out our revenue accounts, we're going to debit them. We're going to close out our expense accounts, we're going to credit them. So that'll bring them to zero. We're going to end up needing a credit to balance that account to zero, or that journal entry to zero. That's the net income that you had for that period. Where does that credit go? That credit goes into retained earnings. Okay, so retained earnings is a accumulation of all of the operations that the company has had since its beginning. Okay, so as a company ages, as long as it's successful and is making a profit, and it's not distributing all of its profits, we're going to assume that the retained earnings account is going to grow. Okay, now, just a few things I want to talk about with retained earnings. Retained earnings, if you have a company that has a tremendous amount in retained earnings, you say to yourself, wow, that's great. That's a company that's been successful for a very long period of time. And they have accumulated a lot of earnings in the company. Well, it becomes an interesting problem because you look at retained earnings, and that's actually exactly what it is. Hey, this is a track record of the company. They've been retaining earnings in the company. They've been using that money to grow. And what should happen is it should reflect that the company is becoming more and more and more valuable. We have a concept of what's called appropriated retained earnings and unappropriated retained earnings. And I think we'll deal with that a little bit in, maybe not this class, but if you have appropriated retained earnings, what it means is that the board of directors for the company, in its wisdom and trying to come up with the long-term plans of the company, they are trying to reserve some of the earnings of the company for future growth. Okay, because see, unappropriated retained earnings can be distributed theoretically as dividends to the shareholders. Okay, so if I had $1 million in unappropriated retained earnings, the shareholders could theoretically get together and say, hey, you're holding too much money back. you shouldn't be accumulating the earnings. You should be distributing that to us, the shareholders, and try and make a move to try and collect the money and take it out of the company. So a lot of times what you'll see is a board of directors say, listen, we have plans for future expansion, growth of the company. We want to build a new plant, buy new equipment. We're going to expand. And we look at the future and see that it's probably going to cost us $1 million to do the expansion that we want. Okay. And if the company is, long been running and very successful, and it has, say $2-3 million in retained earnings, the board of directors could order the accountants to appropriate $1 million of the retained earnings. What would happen then is on your balance sheet, you would see $2 million in unappropriated retained earnings and $1 million of appropriated retained earnings instead of $3 million all unappropriated. What that is it's a sign that the company wants to start accumulating the earnings so that they can invest back into the company. Does that mean that the company has the ability the next day to go out and sign a contract for $1 million addition to the new building to the plant? Do they have $1 million in cash? Is my question. What do you think? Emily, do you think they have $1 million to pay? Can they do that?
I mean, no, they don't have the cash or like the actual like money to do that. They probably have to liquidate it somehow.
Yeah, exactly. The fact that we have retained earnings doesn't necessarily mean we have cash. What it means is we have wealth, that there's some value in the company. But I always found that to be an interesting exercise when a board of directors would go through and do an appropriation of retained earnings. It basically, in my mind, is a symbolic gesture, trying to tell everybody, hey, be aware that this may affect your dividends as we go into the future. We want to start accumulating some of our earnings to pay for our growth. Okay, and we're going to talk about the balance sheet today. But one of the things that we did see in that last chapter, let me go back to it if I can. A second. All right, now I'm going to share this. Just give me a second. A lot of clicks. All right, so this is from the textbook. It says, before proceeding further, and this is after we looked at the income statement, and the next thing, if you look at this page, is the statement of retained earnings. But the sentence here at the top, it says, we should note that there are three primary sources of capital. Capital meaning, how did we fund, how did we pay for the assets that are in this company? Okay, there's three primary sources of capital. In this particular instance, if you remember Kramer Corp from last class, bondholders who received $20,000 in interest. Okay, so the bondholders, when we look at the balance sheet, we're going to see how much money the bondholders have put in to help us buy those assets. The preferred stockholders, and they receive their dividends, and the common stockholders who we eventually pay dividends to. So when you look at actually funding the operations of a company, you have to look, and give me a second, I'm going to move forward. I didn't know if I'd be able to do it, not lose you. So what to do, I'm jumping a little in the chapter, but I do want to do this. I'm going to share this now. And this is a few pages further in the chapter, but this is the balance sheet for the end of that year for Kramer Corporation that we were looking at for the income statement. But if you come down here, you've got the balance sheet, but you've got assets. And in this company, we've got $1 million worth of assets. And then we've got the other side of the equation, the remainder of the balance sheet, or basically the assets are the debit side of the long-term accounts, and the right-hand side of the bottom of the balance sheet are all the credit balances. Okay, And this tells us how we paid for the assets that we're using to run this company. And so that's what this is, the liabilities and shareholders' equity section of the balance sheet. All it's telling us is, where did we get the money to buy that or hold that $1 million worth of assets? Well, you see that we have current liabilities of $210,000. And so that means that our trade partners, the people that we're buying money from, have lent us money. Okay, they've lent us $210,000 to run our company. And then we talk about those bondholders that got the interest. Well, the bondholders paid in $90,000. So $90,000 came from these bondholders. Then we have $50,000 worth of preferred stock. So those, the preferred shareholders, they gave us $50,000 to buy that $1 million. And then our common shareholders, and we'll talk about this later, we have the common stock here for $100,000, and then we have capital or excess capital paid in of $250,000. So $350,000. Then we have retained earnings of $300,000. Okay, so that gives us $700,000 total for the owner's equity portion of this. And then $300,000 comes from money that we borrowed somewhere, either from banks or from our vendors or from these bondholders. That gives us the $1 million that shows us how we paid for the $1 million that's on the asset side of the balance sheet. But this portion here, retained earnings, and if you remember, we had that, we did that statement of retained earnings and ended up with $300,000. This $300,000 is money that was retained in the company, income that we did not spend on other expenses, money that we didn't spend by paying out dividends to anybody. It's money that we retained in the company. Now, it's not in cash, because if we come up here and look at cash, we only have $40,000. So we would be terrible businessmen if we said, oh, yeah, we have $50,000 additional income that we were able to retain in the company. Let's put it in cash and leave it there. No, you don't make money as a business person by holding cash. You make money because you have confidence in your company that you will reinvest your income into the company, because you know you're going to get a better rate of return by operating your company than you are having the money sit in either a checking account as cash or in some sort of a short-term investment where you're getting some sort of bank interest. You have to believe that operating your company is going to be the best use of that money. So this $300,000 that we have here in retained earnings, we don't have it to spend because we've already spent it somehow on these assets. It didn't end up as an expense, so it didn't end up on the income statement, so it didn't get washed out of the company. They're still sitting here, okay? So some of these assets, or at least some portion of these assets, were paid for by the company continuing to hold retained earnings. Okay, so that's what that's all about. Let me get back to where I want to be in the chapter. Just sort of went ahead so I could grab that balance sheet real quick. The chapter has a discussion about price earnings ratios, PE ratios. Anybody want to talk about price earnings ratios? Do you know what they are? How valuable are they? What kind of a tool are they for you? Anybody have a feeling for that? Price earnings ratio? It's a mathematical thing, okay? So basically what it does is it is a ratio that is created by what? Price of the stock, market price of stock divided by the earnings, okay? So if we had a market value of the stock of $20 per share, and our earnings per share, which we calculated back last class, this was the money that was available to common shareholders. So this is the bottom of the income statement after we got done paying the preferred dividends, was $1 per share. If our market price was determined to be $20, so we would divide 20 price divided by the earnings per share, $1 per share, our PE ratio would be 20. Okay. I'm going to be very honest with you. I don't know that that really does a whole lot for us. I do want to show you a chart that is in the book. Like I said, you guys can look at it if you like, but here's a chart, and this goes for a period from 1990 to 2010, and it has a bunch of different companies here and shows what industry they're in, and it shows their PE ratio. Okay, so let's take a look at Bank of America for starters. They're a bank, and 1990 they were 11. Their PE ratio was 11. 94 it was 8. 98 it was 19. 2001 it was 13. 2006 it was 12. 2010 it was 10. All right, so it's a company that seems to be in an industry that's relatively stable. And their PE ratio isn't all over the place. It goes from a low of 8 to a high of 19. But it looks to me, if you look at those numbers, that maybe it's something that should be hanging around between 12 and 14, maybe, for the company on a regular basis. But let's look at a company like Cisco, which is in the networking business. 1990, their PE ratio was 25. 94 was 24. 98 was 37. 2001 it was 91. 2006 it was 23. 2010 it was 22. Okay, so this is a company that looks like it likes to hang around in the low to mid 20s for a PE ratio. But what in the heck happened in 2001 that gave them a PE ratio of 91? Well, it's a mathematical equation, right? It's price over earnings. Either the price was artificially high at that moment, or the earnings took a very big dive. So if you're divisor, dividend, it's fifth grade math. If the bottom of the equation shrunk, that could make that number be extremely large. Continuing down with this one, if you look at Southwest airline industry, 1990 is a 15, 94 is a 23, 96 is a 16, 2001 is 31, 2006 is 31. In 2010, it can't be calculated because the earnings were a loss. It was a negative number. So you can't come up with a PE ratio when the company has a loss. Same thing with General Motors in 2010. So I don't know. I don't particularly care for the price earnings ratio. It's something that we deal with in this class. Understand that people in the investment world do look at this. They do look to see what the price of the company is when it's compared to the earnings per share. And this is a way that sophisticated professional investors will make their determination as to whether a company is trading too cheap or too expensive. There's no magic number in here that I can say. If it's above 20, it's overpriced. If it's below 20, you should jump on that. No, I don't. I think you have to be a lot more sophisticated than we're going to get in this class to be able to use a PE ratio to understand how the market is going to value these particular stocks. Basically, is what we're talking about. All right, so I want to move on from the PE ratio, and I want to move on to basically it's going to be the balance sheet. We already took a real quick peek at a balance sheet, but where we are now is we looked at the income statement, which was a report which was to give us a measure of the transactions that occurred over a period of time. Okay, whatever our reporting period is, it could be a month, it could be a quarter, it could be a year, whatever. Okay, we're looking at whatever we have here, and like I said, for my purposes, I'm going to have this be a yearly report, and we're going to do it on a calendar year just to make it simple for right now. So it's going to be a 12-month period. So the income statement was January 1st to December 31st. All transactions that occurred over that period of time. The other major financial statement that's out there is the balance sheet. And the balance sheet is not something that you look at for a period of time. A balance sheet is a snapshot. It is what the company's worth or value looks like at a moment in time. Now, generally, it's going to be as of close of business as to whatever your accounting period is. So if we are a calendar year reporter, then our balance sheet is going to be as of December, in close of business as of December 31st, 2022, whatever our year is, okay, 21. Yeah. The book is doing, I think, 2010. It's a snapshot as of that moment, okay? We looked at it a moment ago. We were able to see how we funded our company. There's a lot of information that's going to end up coming from the balance sheet. We're going to do a lot of analysis on the balance sheet to tell us, to give us a bunch of tools to tell how well our company is actually doing. Okay. All right. So, I'm just looking at this in the book, and I have it up on the page on the share for you. Limitations on the income statement. I'm going to stop sharing for a second. We have this interesting concept of income. What is income? Income is basically an improvement in your financial position, right? Okay. When we talk about how we report the income statement, we're talking about revenues minus expenses. Okay. Can you think of a different definition of income, or a different set of transactions, or a different way of looking at things to determine? If we look at income as being the improvement in your financial position, is revenues minus expenses the only way to look at that? What do you think, Lucas?
Probably not, but I would know what else to look at.
Okay, safe answer. It's a right answer. Matt, what do you think? Can you think of another way of defining income? Matt, you out there? That must have run off to the bathroom. Travis, what do you think? Can you think of another answer for a definition for what's income?
Not right now. I don't think I can.
Okay. Let's talk about it from an economic point of view. And an economist would not limit themselves to revenues minus expenses. An economist would say, well, we need to take a look at the value of the entire enterprise. Okay, so what we're talking about is the improvement or increase in the value of the enterprise. So if we were talking about, does having more revenues than expenses, does that increase the value of the enterprise? Sure, absolutely it does. But there are other things that are going on that are not part of revenues and expenses. And an economist would say, we need to take a look at the value of the assets every year too, because realistically, income can be measured just by the overall improvement in the overall value or worth of the company. So let's say we had $100,000 worth of income that we saw from the income statement. But then let's also take a look at the other assets that we have that are the more permanent assets. We bought a piece of land that we built our manufacturing plant on. But we decided at the time that we bought it, say 10 years ago, we thought, you know what, we're probably going to want, if the company is successful, we're going to have to expand in the future. Why don't we buy a bigger piece of property than we need today? So we have maybe a double building lot. And let's say that the industrial park that we are in has become a very, very sexy place to have your business. Everybody is dying to get into this particular industrial park because it's very well located. The infrastructure is great, and the local economy is just going crazy. It's an absolutely wonderful place to be. So let's say that we separated the piece of property that we have, the plant that's built on, we have as one asset. We have the plant and the building and the equipment and the land as part of that particular account. And the vacant land that we have next door, another whole, say it's 2 acres or whatever, we have that listed as a separate asset. And maybe when we bought it for $50,000. Now, 10 years later, because this is a very desirable place to build a business, that piece of property, that piece of real estate that we have is now worth $200,000. Okay? As an accountant, do we record the income or increase in value of the company between the $50,000 we spent on the property 10 years ago and the $200,000 that it's worth today? That $150,000 difference in value, do we record that anywhere? Do we report that anywhere? Is it on the income statement? No, it's not. So those economists would look at our use, or accountants' use, financial people's use of the income statement, and we're going to see the balance sheet also, as missing the boat. We're not seeing all of the changes. So the economist's view or definition of income being any increase in value or worth, what we do in the accounting and financial world doesn't agree with what the economists would do, okay? We look at income as being revenues minus expenses. When we look at the value of a company, we don't look at what the assets are worth today. We have no idea what they're worth. We know what we paid for them. We're historians. The accountants out there, you guys are historians. So if I asked you, hey, what did we pay for that extra piece of property that's sitting next door? You could easily look at your records and say, we paid $50,000 for it. And if I were to say to that same accountant, what's it worth today? They'd say, I don't know. How would I know that? And they would be very reasonable in saying that. The accountant doesn't have any reason to know, because the accountant is only concerned with the historical value. Now, if I wanted to get a value for that, what would I have to do? Is that something that I'm doing in my ordinary course of business? I'm manufacturing widgets. Somehow, in my widget manufacturing process, I'm going to come up with the value of a piece of property next to me. I'd have to go get a real estate appraiser to do the appraisal lines. And then it would just be his opinion as to what the value is. The true market value of something is what a willing buyer is willing to pay to a willing seller. Okay. All right. You could have a certified appraiser come in and he'd give you his best guess, and hopefully it would be something relatively close to what the real world is. But the economists out there, they say, no, you're not doing it right. We say, well, we're accountants, and this is the way we do things. Now, there's a criticism of the accounting world with the fact that that's how we do our record keeping, that it's historical and we're not worrying about changes in value. And other countries around the world do put a little bit more importance on the actual market values for their assets than we do. Our accountants are basically using the generally accepted accounting principles, and we worry about historical value. Back in the 80s, we lived through a time with very high inflation. And there was a criticism of the accounting procedures because of the fact that prices were changing so rapidly and so dramatically on a very, like I said, rapid basis. There was a criticism of the accounting world saying these statements don't mean anything because the values, the prices of things are changing. Every year, inflation was, we had double-digit inflation for a little while there in the 80s. And so if you had, say, 12 to 15, 12% inflation one year, 15% inflation the next year. So over a 2-year period, you had a 27% increase in prices, and you're using historical value for 10 years ago. Your numbers don't reflect the real world at all. So back then in the 80s, there was a discussion that the accounting world, the accountants in the United States, should basically make an adjustment and start doing that. Start trying to take into account, or at least do in audits and whatnot, that there be, maybe not in the main statements, but in the notes, some sort of disclosure as to what we believe the assets were actually worth. Okay. Now, what happened, of course, is we went into a period of time of very stable inflation, where inflation was 1%, 2%, 3%, 2%, 1%, 3%, 2%. It wasn't a dramatic thing. And so the requirement that financial statements, at least in a note, describe what the actual market values of the assets were, sort of died off. Now, we've gone into a period of inflation now because of the pandemic, and also all the stuff that's been going on with governments manipulating the economy. Are we going to go into a period of time where we're going to have inflation that's going to be more pronounced than it's been in the past? Maybe. If that happens, are we going to have people, rabble rousing again and saying, "Oh, we need to make sure that we have some sort of statement out there talking about market values as opposed to historical value"? Maybe. I don't know. We'll see what's going to happen. It's always interesting to watch what happens in the future when you can see what the past was. All right, so let's talk about the balance sheet. The balance sheet is a list of the assets that we own, the debts that we owe, and the historical source of our equity funding. Okay, it is a picture at a point in time, and we report at original historical cost basis. Okay, so if I were to, one of the things we're going to end up with here is we're going to end up with a valuation of the company, a market valuation, or a book value, a book value of the company. The net assets, if you will, divided by the number of shares. And when we get to the end of this at the end of this particular chapter, we're going to see that Kramer Corp is going to end up with $700,000, it's $1 million in assets minus $300,000 in liabilities, giving you $700,000 minus $50,000 for the preferred shareholders, meaning that the common shareholders have $650,000 worth of value for 100,000 shares, or a market value, or a book value, not market value, I misspoke, a book value of $6.50. Okay, so what does that mean? Does it mean anything? It gives us a tool. It gives us something to look at, but does that actually mean that it's worth, that share is worth $6.50? It could be worth more. It could be worth less. I don't know. All right, so how do we present our income statement? How do we line it up? Because if you remember, when we went over the income statement, I told you that there was a specific order that I wanted to see things in, at least as far as our class is concerned. We're going to have, sales minus cost of goods sold, and the first place we're going to stop, that's going to be a big number that we care about, is the gross profit. We're going to play with that number. Then the next number that we have after that is EBIT, earnings before interest and taxes. So you're taking your administrative costs and such out before you get to EBIT. Then you're going to take out the interest and come to EBT, earnings before taxes. Then you're going to take out taxes, and you're going to come up with earnings after taxes. Those are the stops, and that's the order that we have to go in. How is a balance sheet ordered? Well, a balance sheet is ordered in terms of liquidity. Okay, so we're going to have the most liquid stuff listed first. And when we talk about liquidity, we're talking about how easily the asset or the item can be turned into cash. So on the asset side, how quickly can the asset be turned into cash? So the very first item that's always going to be listed on our balance sheet is going to be cash. Why? Because how long does it take cash to be turned into cash? Well, it doesn't have to be. It's already cash. So it's as liquid as you can get. It is cash. Then we're going to talk about the other current assets, things that get turned into cash in a relatively quick manner. The definition here is usually within 1 year, you can turn your current assets into cash. Okay, that's going to be things like accounts receivable, inventory. We could theoretically have some marketable securities there. If we had an overabundance of cash and we're holding cash for a particular reason, we know we have a big bill coming up. We know we want to invest it. We have a big purchase coming up. We may be holding cash, but we don't want to hold cash because cash is not going to make money for us. So if it's something where we can't afford to put it back through the business cycle at that moment, we may drop it off into some sort of marketable securities. Go out into the market and buy some sort of a government bond or a treasury bill or a note or something like that. Those are marketable securities. You may have them. You shouldn't have a whole lot of cash because cash doesn't make you as much money as your assets do. Okay, so as I said, accounts receivable, and inventory. After that, we're going to get to investments. Unlike marketable securities, they involve a more long-term dedication to that particular item. So investments are things that we plan on keeping for more than 1 year. They're not necessarily assets that we're using in the business. So this is money that we are investing so that it's getting us some profit, but it's something that's it's going to be probably maintained as an investment for more than a year. After that, we get to the more long-term stuff, plant and equipment. Okay, so plant is basically going to be considered to be our building, our land and our building. Okay, we should keep track of our land separately from our building. Why? Because out in the real world, we're allowed to depreciate our building. We're not allowed to depreciate our land. So in your books, you're probably going to have that as two separate accounts. For our purposes, we're going to have it all sort of bunched together. It doesn't matter to us in the finance world because we know we can't have a building without the land to have it on. Equipment is the other thing that's in this category. We probably, if you look at your building, you probably believe it's going to be a 20 or 30-year investment for the building. You're going to have a commitment, a long-term commitment to your equipment, the things that you're going to use to make money, the machines that are going to be used to make your widgets. I guess even the office equipment and office furniture is a long-term thing. So that would be under equipment also. Those are assets that are used in the business and certainly things that we expect that we're going to have for more than a year. If it's something that we're going to buy and it's going to be used up within 1 year, it's probably going to be an expense as opposed to an asset. So it'll be on the income statement as an expense as opposed to being an asset on the balance sheet. Okay, so that is the asset side of the balance sheet. Very liquid, current assets, expected to be able to turn into cash before 1 year. Then we can have sort of a medium-term thing that we'll call our investments. Those are assets that are probably not directly related to our business, but it's investments that we plan on having for more than 1 year. After that, we're going to get into our long-term assets, plant and equipment, and those types of things. Okay, those are our total assets. Those are the categories for them. So now we have to move to the other side of the balance sheet because our balance sheet has to balance. What do we do here? How do we list the items on our balance sheet? Exactly the same. We're going to do them in terms of liquidity. Not necessarily in terms of how quickly we could turn them into cash, because we can't turn liabilities into cash, but basically how long are we going to be able to take before we have to spend the money to pay off those liabilities. Okay, so short-term obligations are things like accounts payable. Okay, We are a company that has been running for a while. We have an established reputation. Our suppliers are willing to sell to us on credit. At the end of the month, we'll get a statement from them that they require that we pay. We have to pay everything net 30, whatever. So accounts payable are certainly going to be paid in the short term. We can also have notes payable here, which are going to be, IOUs of some sort. We're going to owe somebody something, but they're not necessarily going to be something that's going to be more than a year, or hopefully be less than a year. All right, so I'm going to go back to sharing because I'm on the page in the book now where we have the balance sheet again. So let's take a look at the balance sheet of Kramer Corporation. Per the book version of the book that I'm using electronically here, December 31st, 2010. Assets, cash, current assets, cash, marketable securities, accounts receivable, inventory, and prepaid expenses. We'll talk about this. Cash, we have $40,000. It's as liquid as it can get. That is cash. Marketable securities, we have $10,000. This is something that we have the ability to immediately sell and turn it into cash within a matter of a day or so. We probably have to wait for the security to settle, but usually it's the type of thing we will get paid in a day or so. Accounts receivable. It's still a current asset because we expect our accounts receivable to be paid within a year. Later on, we're going to find out that we will end up treating this differently when we're trying to finance our company, because accounts receivable, this is never going to go to zero, is it? Unless I stop making my product and stop billing my customers, I'm always going to have accounts receivable. But the whole point of it is that $220,000 that's in accounts receivable. Now I have an allowance for bad debts of $20,000, so I'm only expecting to really collect about $200,000 of these. This $200,000 a year from now is not going to be the same $200,000. First off, that number should move one way or another, up or down. But beyond that, it's not going to be the same customers owing the same amounts for the same invoices. Hopefully, all of this has been collected, hopefully within 30 days of this statement, and we have all new debt on the next balance sheet that we see. So this should be collected in the short term. Okay, inventory. We have $180,000 worth of inventory. We should probably be rolling our inventory more than once a year, right? This is something that we will spend some time with during this semester, trying to figure out how to most efficiently use this particular asset. If this $180,000 represents all of the inventory that we're going to need to produce our product for this year, we have way too much inventory. There's no reason to invest $180,000 in inventory that we're not going to be using until next, 6 months from now or a year from now. We should have as much inventory as we need in order to be able to maintain the production schedules that we want to have. So once again, how long should this inventory take to be turned into our product, which will then be turned into cash? We have this listed as a current asset because we certainly want this to all happen within a year. Okay. Now, if you're a good company, you should be able to get that inventory rolled in, say, 45 days. Let's just use that right now as a target. We buy a piece of inventory. It's steel that goes into our inventory to make our widgets. And that steel sits in inventory and we use it. So over the next 45 days, all of that steel that $180,000 represents has been consumed by my manufacturing process. Once again, I'm probably going to be buying more steel because unless I'm planning on stopping production, I can't let that number go to zero. That means I can't physically have no inventory waiting to help me produce my product. Okay, but whatever is in that $180,000 right now, it will be gone within 45 days. It'll be in the product that's been sold, okay? Prepaid expenses. We have $20,000 worth of prepaid expenses here. Prepaid expenses are expenses that you prepay. Oh, there's a great definition to give the students, John. This is an accounting thing. This is as we look at the end of a period of time. You know, we're here at December 31st. So once again, this is a snapshot. There are certain types of expenses that we are required to pay in advance. Like our inventory, we're going to buy it. It's going to sit in our yard for 45 days till we use it, but we don't have to pay for it for 30 days. So accounts payable, when we get to the liability side, that is going to, it's going to take care of itself there. But prepaid expenses, because we have to draw a line in time here, certain types of expenses. For example, insurance. Your insurance company wants you to pay your premium on your insurance in advance, okay? Whether it's on a yearly basis, you pay it in advance, or quarterly, or half a year, or whatever, but you're paying that in advance. Why? Because the insurance company doesn't want to wait until you're done with the period of time, and then you say, oh, no, we're not going to pay now, because that's how the insurance company makes its money. It makes its money by you paying in advance, and then either paying your claims or not paying your claims because you didn't have any, okay? So if I was required to pay my liability insurance on September 1st, October 1st, and it was for a year, then I've only used up 1/4 of that. I still have 3/4 of that payment that is not an expense, it's an asset. It's a prepaid expense. So, whatever the 3/4 of the value of that insurance payment was, it's a prepaid expense, not an expense. Another thing you pay in advance is rent. So if I'm renting the factory building where I have my business, my landlord wants me to pay it the first of the month, not at the end of the month. Okay, so on December 31st, let's say that I was required to pay, because of the way that the weekends were going to fall or whatnot, I had to pay the rent bill on December 31st for January. Then the entire payment is a prepaid expense. I haven't used any of it yet. I've paid it, but it's an asset, not yet an expense. Eventually, the accountants are going to have to take it out of there and put it into a legitimate expense when we use it up. But as of right now, for accounting purposes, it's an asset. Is it going to be used up within a year? Yeah. The rent will be used up within a month. The insurance will be used up within 9 months, so on and so forth. All right, so on the balance sheet here for Kramer Corp, we have a $450,000 in current assets, okay? Now, the Kramer Corp has $50,000 in cash that they didn't know what to do with, and so they decided they would invest it in some sort of securities, okay? So under other assets, they have investments there. Whatever the type of investment that they have is something that they expect to hold for more than a year. So that's why it's there as other assets as opposed to current assets. Notes receivable or investments receivable or something would be a current asset if we expected to clear it within a year, and it would be up in the current assets. This is something we expect to keep more than a year, so it's not in current assets, it's in the sort of middle category. All right, so then we end up with the fixed assets for this company. We have plant and equipment at its original cost. $1,100,000 is what we spent. So that's probably a combination of land, buildings, and various pieces of equipment. Now, accumulated depreciation is the next thing that's on our balance sheet. For those of you that understand and love the accounting world, this is not necessarily an expense because we had, the other side of this entry is depreciation expense. This is the credit side of that equation. So the debit end, or the entry would be a debit to depreciation expense and a credit to accumulated depreciation. That accumulated depreciation account is what we refer to as a contra account. It goes against an asset account and nets the value down. So our asset accounts here are the $1.1 million in plant and equipment. Our contra account is accumulated depreciation at $60,000. We subtract that. So what we're reporting here on our balance sheet is the net historical value of our plant and equipment. We paid $1,100,000. We've depreciated $600,000. That leaves us $500,000 worth of value on the book, or book value. Okay, our assets have a book value of $500,000. Now we just add up all of our assets. Current assets of $450, midterm assets here of $50, that gives us $500. Our net value of plant and equipment or long-term assets of $500. So $450, $500 plus $500 is $1 million. That gives us $1 million worth of assets. Okay, our company has assets worth, on a historical basis, $1 million. How did we fund it? Once again, that's all we're talking about when we talk about the other side of the balance sheet. How did we fund it? Do we owe people, or is it equity? Well, current liabilities, long-term liabilities, and then shareholders' equity. Okay. Accounts payable, $80,000. Current liabilities are liabilities that we expect that we're going to have to pay to liquidate, to turn to zero, if you will, within 1 year. Accounts payable. These are trade accounts payable. These are the amounts that we owe to our vendors who have sold to us on credit. Normally, this is going to be a net 30. So is it reasonable to think that we're going to pay all of those accounts payable at $80,000 within the first year, the next year? Yes, is the answer. Is that going to go to zero? Probably not, because we're going to have new accounts payable, but those exact accounts payable will be paid, in theory, within 30 days. Notes payable. Notes payable are, once again, IOUs. This is money that we owe somebody. We had to borrow from somebody. Somebody gave us money for a very short period of time, under a year. If it was over a year, then it would be a long-term liability. But this is something that if somebody lent us money, expecting us to pay it back within a year, so $100,000 current liability. Where you see this in the real world is if you had a small company and there was a cash shortage that was coming along and the company needed cash. Oftentimes the owners have significant assets of their own outside of the company. So you could go to the bank and borrow that $100,000 to pay your bills. Or if you had one of the owners that was willing to say, hey, I've got the money, I'll put it in, they'll lend the money to the company. It should be an arm's length transaction, meaning that they're going to charge interest. It should be market interest. So if the bank would charge you, say, 10%, the owner shouldn't be charging 20%. He should be charging something close to market rate. So if he's charging 9 because he wants to give the company a break, that's fine. If he wants to charge 10 because that's actual interest rate, even if he charges 11, that's still going to be reasonable. Okay. Accrued expenses. Accrued expenses. These are other types of expenses that have been accrued, but they're not sitting in accounts payable. Much like the prepaid expenses over here, these are expenses that we may not have an invoice for, but we know that there's a bill coming. When I was out in the world working as an accountant, the one company where I was actually this is the company where I was the vice president, I had an accountant who was very, very reluctant to make any kind of estimates. It was like, Bill, we're getting to the end of the year. I need for you to estimate what some of these expenses are going to be. We didn't have a bill yet, so it couldn't go into accounts payable. But what I wanted him to do, we had a big factory, we had a big building, and I needed to know what our utility bills were going to be. I needed to have a heating, a natural gas expense for December. I needed to have an electric expense for December, those types of things. And he didn't like to make estimates. Now, he could have looked at last year's bill and he could have adjusted it up or down by some percentage, make some sort of a reasonable estimate of what the bill would be, and that's where it would fall. It'd have an expense over in utilities expense, and the credit would be over here on the balance sheet, not in accounts payable because we don't have a bill yet, but in accrued expense because we accrued an expense through the accounting process, not because we had a bill. Bill couldn't, Bill just couldn't do it. He would wait, he would hold off. We would not get our financial statements until way later than we wanted them to, because he would just wait until he got the bill and then put it in through accounts payable instead of making a reasonable guess. I remember the CPAs used to get so angry at him because he was concerned, if he took his best guess, maybe our monthly bill for our natural gas was $8,000, something like that. And if he would have looked at last year's or the last couple of years and seen, that it was maybe in the area of $7,900 or something like that. And even if he would have taken a guess at like $7,500 and the bill was really $8,000, the accountants told him, Bill, it's only a problem if it's a material error. A $500 round or estimating error when your company has $30 million in activity is not, something we worry about. God, he couldn't do it. Current liabilities, $210,000. Okay, so we have bonds payable. So these are people that lent us money, that we're agreeing to pay interest to them. And according to the notation here, you remember this is as of 2010. These bonds are due in 2015. So there's $90,000 worth of bonds out there. So total liabilities, $210,000 plus $90,000, or a total of $300,000. Okay, right here, we have $1 million in assets. We have $300,000 in liabilities. That tells me I know my owner's equity has to total $700,000. Why? Because a balance sheet needs to balance. Okay, if your balance sheet doesn't balance, it's not a balance sheet. All right, so what's in shareholders' equity, stockholders' equity? We have preferred stock here, $100 par value. So each share of preferred stock cost $100. We have 500 shares that we sold. So 500 times 1,000 means that we raised $50,000 when we sold those shares of preferred stock. Okay, I talked about what preferred stock is. It is equity. It falls in the owner's equity section of the balance sheet. So it is equity. Common stock. We have a $1 par value to our common stock, and we have 100,000 shares out there. So 100,000 shares times $1 gives me $100,000 of common stock. That means our shareholders, our common stock shareholders, paid in $100,000 for those 100,000 shares of stock. No, they didn't. Because of the fact that we have this other account here, capital paid in excess of par of the common stock of $250,000. If we were to add these numbers, 250 plus 100, that gives us 350,000. If we divided by that by the number of shares we have, 100,000 shares, we would end up with a price that our shareholders paid of $3.50. So our shareholders were willing to pay $3.50 for a share of stock that said on its face that it was $1 par. Now, the par value of the share of stock means nothing. Means nothing as to its market value. It means nothing as far as how much you sell it. It's an accounting thing. So I have 100,000 shares and it's $1 par. I'm gonna have common stock at $100,000. Everybody paid $3.50. But I can't put that, according to the accounting rules here, under common stock because I have a par value here. So anything that you paid in excess of the $1 for your share of stock is going to go into this separate account over here, paid in capital in excess of par. Okay, so we have $250,000 here because everybody paid an extra $2.50 for their share of stock. Okay, so if we were to add this up, $250, $350, $400,000 in ownership, that we have certificates out there. Then we have this number of 300,000 for retained earnings. We saw where that came from. I think we had 250,000 at the beginning of the year. We added in $100,000 of net income, which took us to 350, but we paid out $50,000 in dividends to our common shareholders. So 250 plus 100 minus 50 gives us 300,000. 300,000 plus 400,000 gives us 700,000. 700,000 plus 300,000 gives me $1 million. Okay, that's how you read a balance sheet. Okay, that's where the numbers come from. Those are the important numbers that we look at in this particular. Stop share. That's what we have to look at in a balance sheet. Okay, I'm sure you guys have done this. I'm sure that this is not new. Maybe it's review. I don't know when the last time you had an accounting class or really worried about accounting, but that's how we care about this. Okay, now I'm going to look and see where we're going now. If you look in the book, I'm sure they go through a whole lot of explanation of each of those things that I just talked about. All right, so the next thing the book really wants to talk about is this concept of net worth. This is where they're going to calculate out the book value per share of a share of stock. What's the company worth? What's the book value? What's the overall value? And I already did this for you, but I'll show it to you. I'll share it with you. I've got it right here from the book. Share screen. Share. All right. Concept of net worth. Total assets of $1 million. Total liabilities of $300,000. That's not money that we own, right? It's money we owe to somebody, either in the bonds or in the trade payables, or so on. That gives us stockholders' equity of $700,000. We saw that from the balance sheet. Once again, the preferred shareholders are only going to get the value of their share of stock. They don't share in the growth of the company. What they give up, but they give that up for a guaranteed percentage payment in dividends, okay? So they don't get to share in our growth. So we have to take them out of the equation. So the owner's equity balance of $700,000 minus the value of the preferred stock gives us $650,000. We have 100,000 shares of stock. We now divide the 650 by the 100. That gives us $6.50. That is our book value. So in theory, our shareholders, now we also know that they probably paid $3.50, right? Because we have the dollar par value plus the $2.50 of paid in capital. So they paid $3.50, and over whatever period of time this company has been in operation, the value of the company, according to the books of the company, has gone up to $6.50. Okay. Now, once again, the book wants to talk about the PE ratio. So if we take a look, we had a PE ratio of $15, and we had $1 earnings per share. It would have a PE ratio of 15 with a book value of $6.50. All right. Let me change back. Oops, can't do that. Can do this. Got you really bored so far? Anybody still awake? This is
Sure.
Oh, you're still awake? Great. All right. So, what does that tell us, though? You know, once again, we have the book value. It tells us, in theory, that I guess if we were going to liquidate the company and we were able to sell off all of our assets for exactly what they are on our books for, then that's what we would end up giving each of our shareholders, right? So, all right, time for us to go out of business. We're going to collect all of our accounts receivable. We're going to sell all of our inventory back to the people who sold it to us for exact refunds. We're going to collect all of our notes payable We're going to cash in all of our investments. We're going to pay all of our trade creditors. We're going to pay our bondholders. We're going to pay off our preferred shareholders. Say, hey, look at that. We have $650,000 left. There's 100,000 shares out there. Everybody gets $6.50. Yay! Real world, not a chance that any of that's going to happen. Okay? First off, we don't necessarily like to try and value a company that's going out of business. We like to try and value companies that are ongoing concerns, right? And a company is going to have a much larger value if it's an ongoing concern, especially if it's profitable. I'm going to tell you right now that when you are doing a valuation out in the real world of a company, and for whatever reason people have asked me to value their companies, there are CPAs that are specially trained out there in doing appraisals of companies. They're very expensive, but they're very good. I'm not saying anything bad about those people. I have used them. I have hired them in my career. They're wonderful. But they don't necessarily take a look at the balance sheet and say, oh, well, but $6.50. It's, you know, that's what the company's going to be worth. Everybody's got a value of $6.50. They're not going to do that. When an appraiser looks at a company, they look at two things. They will look at the value of the long-term assets. Do you have land? Do you have building? What's the value? And they'll do an appraisal on the land and buildings to determine if this company were to shut down and you did have to sell the company, what could you get for that? Okay. They'll also look at the company as a going concern. And the value of a company as a going concern, I'm going to tell you right now, out in the real world, it has nothing to do with your balance sheet. The value of your company out in the world, as far as market value, if I had a company that I was operating, Komolchek Widgets, I want to get out of the business and I want to sell it to somebody. If I was marketing my company, you would not be looking at my balance sheet. You would be looking at my income statement. What? How can the income statement give you values? In fact, the balance sheet is where we have all of the values. Yeah, no, we have historical data on the balance sheet. It doesn't tell us anything. You don't have any idea what the value of the land is. You have no idea what the value of the building is. You have no idea what the value of my inventory is. My inventory could be obsolete, just sitting on the books. It could be stuff I don't even use, but I haven't bothered to dispose of it. You have no idea. My balance sheet tells you nothing. Most appraisers are going to look at your earnings for some period of time, usually the last 5 years. Because an appraiser will assume that you're going to have business cycles. You're going to have some years that are going to be good. You're going to have some years that are going to be bad. You know, the economy has its ups and downs. Usually a 5-year period, an appraiser believes that they're going to see the ups and the downs of the company. And the appraiser will tend to average out what your net income, what your net earnings were over that 5-year period. Then what they're going to do is they're going to look at what industry that you're in. And there are multipliers out there in the real world that appraisers use to determine what a value of a company is. So if we were talking about the widget manufacturing industry, and we had a sophisticated appraiser who's going to appraise my company because I want to sell, they would come through, they would look at my income statements for the past 5 years, they would look at the balance sheet to make sure I don't have assets that are crazy overstated or crazy understated, to make sure that I'm kind of reasonable with what I've got on my books. But then they would look in their resources and come up with, okay, let's find out what industry. Oh, the widget making industry. Okay, widgets, that's usually a factor of 10. So if I had average earnings of $100,000 over that 5-year period, the appraiser would then apply the multiplier, the factor of 10, and they would say that basically my company would be worth $1 million because you could expect to make $100,000 a year, and the multiplier is 10. You know, I don't know if that's reasonable. Once again, every industry is going to have its own multiplier. A reasonable factor for an insurance company might be 5. A reasonable factor for a heavy manufacturing company like General Motors might be 10 or 15 or 12. I don't know. I'm not an appraiser. I don't know those answers. But that's really how you value the market value of the company. How do you come up with the market value of a big, huge Fortune 500 company that's publicly traded on the New York Stock Exchange? Well, you look at the market price. You know, what's it trading for today? And then multiply that by the number of shares that are outstanding. That's your market cap. You know, so if I have 1 million shares and they're trading at $10 a piece, my company's worth $10 million because that's what the market thinks it's worth. They'll come up with their own multiplier. The market will set those standards. All right. Once again, I seem to have run out of time. I seem to be able to talk for 1 hour and 20 minutes with very little difficulty. That's just because I have so much to say. That's just because there's so much. There is so much in this book that you guys want to know. Just telling you. So we'll continue with chapter 2 on Tuesday. My guess is we'll probably finish up chapter 2 on Tuesday. And I believe that that's a point in time where I said we would have our first test. So just right now off the top of my head, expect a class on Tuesday, probably still remote. There's a chance I might be back on Tuesday, but I'm not positive of that. So let's assume I'm going to be remote still on Tuesday with our first exam being on Thursday. Questions from anybody? All right. If no questions, we've done a lot of thinking and searching and looking through the things here in the first couple chapters. You know what a finance person is supposed to do. You know how to do a more in-depth view of your financial statements. On Tuesday, we're going to talk about the statement of cash flows, which is more useful than the income statement and more useful than the balance sheet. Okay. All right. If that's all, if no questions, then that's it. We'll see you on Tuesday.
Have a good day.
Thank you.
Have a good day, Professor Kowalczyk, and a good weekend.
Thank you, Owen. You too.